Today, games people play when passing the buck, a New Zealand case study. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and prop news with a distinctively Australian and New Zealand perspective. Well, have you noticed how everyone is now trying to pass the buck for the failed monetary policy, the disastrous results of which were magnified by the COVID response? Politicians are pointing to central banks, central bankers are pointing to conflicts between Ukraine and Russia, and then also point to the COVID which caused supply chain disruption, which, by the way, was largely created by households and businesses suddenly being given cash to buy stuff, creating high demand as the lockdowns took a toll. In effect, no one in authority wants to accept they helped create the problems that we're now facing. And because of that reflex, we may not get to first understand the root causes which created the issues, and secondly, how to address them correctly so to avoid similar issues down the track. Now, on just this theme, Bernard Hickey wrote an interesting piece on the New Zealand site interest.co.nz titled "Reserve Bank may have lots of good company in the money printing dog box, but that doesn't let it or the government off the hook on inflation." Inflation, not seen since the eve of the creation of our independent inflation targeting Reserve Bank in 1990, has unleashed a blame game that has yet to really target the central bank's responsibility for keeping inflation around 2%. The opposition is blaming the government, which is complicit, but it is the Reserve Bank that should be first in the firing line and subject to an independent and full review. So far, neither the Reserve Bank nor the government have acknowledged that they are at least partially responsible or started to talk about what they would do differently in future. The Reserve Bank's only self-reflection has been to self-justify and run its own regular 5-yearly review of its monetary policy mandate. Meanwhile, Finance Minister Grant Robertson's arguments have been all about deflecting blame overseas. The opposition has chosen largely to focus on attacks on the easier political target of Labour's addiction to spending, rather than break the habits of political lifetimes and criticise the independent central bank. Neither of those three strategies are credible in the long run, and all three players only need to look to their colleagues in Australia to see that a truly independent and deep review is needed. The new Labour government of Australia launched a bipartisan independent review of the Reserve Bank of Australia's money printing on Wednesday, which did go on for longer than our central banks, but has had broadly similar effects on house prices and inflation. Also, we now have credible and trenchant criticisms from establishment figures of the Reserve Bank, such as former Reserve Bank Chief Economist John McDermott, ex-Reserve Bank Deputy Governor and Acting Governor Grant Spencer, and former Reserve Bank Board Chairman Arthur Grimes, who was instrumental in building our independent inflation targeting regime in the first place. There must be a serious, deep and independent review of the Reserve Bank's actions in 2020 and 2021, if only to win back the trust of the generation of renters without generous parents who are now fleeing to Australia to find renewed hope of home ownership and family lives. The Reserve Bank decided in mid-March of 2020 to throw the kitchen sink at the economy to reassure borrowers, home owners and banks that there would be not a depression because of COVID lockdowns. It said at the time it wanted to pursue a least regrets policy. However, within months, it was clear that panic was past and the economy was bouncing back into the shopping centres and open homes with surprising rapidity, along with house prices, jobs and spending. In retrospect, the Reserve Bank should have stopped money printing within a few weeks of the end of the first lockdown in June, or even once the bond markets were unfrozen in May. It should have never removed the LVR controls in April 2020, and it should never have started the cheap loans to banks in December 2020, let alone continued expanding them to the present day. He says, in my view, the Reserve Bank's mistakes were not made in the momentous week of March the 16th to the 23rd of 2020, as the government collectively decided on hard lockdowns, and the Reserve Bank launched a $30 billion money printing and bond buying program, as well as slashing the official cash rate by 75 basis points to 0.25%. Least regrets in the kitchen sink throwing were appropriate then in the fog of fears about 30% unemployment and a global financial collapse. But within a couple of months, the fog was clearing. Now the regrets equal some of the 7.3% inflation. The biggest mistakes were to remove the LVR controls at the end of April and to go on expanding the money printing plans to $100 billion by August 2020, even though it only used just over half of that capacity in the following year. Now, after yesterday's record high 7.3% inflation data for the June quarter from a year ago, it's clear the central bank should have at least a few regrets and should be held to account for them, along with Finance Minister Grant Robertson, who was asked for and gave his approval to the biggest things thrown into that kitchen sink and left there: the money printing, the LVR removal, and the cheap bank lending. The political blame game over the inflation has so far pussyfooted around the main issue. The money printing, which is ongoing, cheap bank loans, and LVR removals fired house prices 45% higher by November 2021 and is now being reflected in the demand-driven inflation in building materials, construction costs and rents. The massive expansion of lending and the sharp rise in house prices was clear by mid to late 2020, but it took until June 2021 to explode into the real economy of rising housing costs. The kitchen sink of monetary policy and prudential policy loosening was done with the clear knowledge of a restrained housing supply and the risk any demand stimulus would have a leveraged effect on house prices and eventually rents. That is exactly what has happened. Just over a third of the 7.3% annual inflation reported yesterday can be blamed on that monetary policy loosening. The rest can be sheeted home to higher global food and fuel prices, although that at least partially is due to the massive money printing also done in the United States, Europe, Britain and Australia over the same time period. New Zealand was not alone in printing money to buy bonds to lower longer-term interest rates. Our Reserve Bank can rightly claim credit for stopping the printer sooner than the rest in July 2021 and starting rate hikes in October 2021 sooner, although by then the Reserve Bank had already printed as much, if not more, in proportionate terms to GDP than those other central banks and took the extra step of relaxing LVR controls. Within 4 months, it was clear the worst was over. Instead, the Reserve Bank went on printing and did not properly impose lending controls, stop printing and hike interest rates for another year. That was when the genie got out of the bottle. Although it's still worth saying the domestic demand-driven inflation genie is only responsible for about a third of the inflation. Even if the Reserve Bank had kept the OCR at 0.25% until October 2021, simply not starting the cheap lending to banks, stopping the printing immediately, and reinstalling the LVR controls would have reduced much of the damage, especially to house prices and rents, which, for example, are now rising at the fastest rate in history outside of Auckland at 5.8%. It's time the Reserve Bank and Labour had at least a few regrets and acknowledged them. The opposition also needs to front up and call for that review, which would at least separate the politicians from the process. The temptation for the Reserve Bank now would be to overreact and hike too much higher than its current plans. Financial markets priced in a rise in the OCR to just over 4% yesterday, which is in line with the Reserve Bank's forecast from May. If it wanted to do more, it could start by ending and unwinding the $12.7 billion of cheap loans to banks through its Funding for Lending program. And it could also further tighten LVR settings and unravel its bond buying program much faster. From a fiscal policy point of view, enacting some sort of angry, fast spending crackdown would be counterproductive and too painful for those who can afford it least. If the opposition were being intellectually honest and wanted to do the least damage, it would propose a windfall profit tax from those businesses who retain the $20 billion in wage subsidy cash in their savings accounts, and some sort of wealth or land tax to reduce house prices and pressures on rents. I think he makes a very good argument. And of course, in Australia, we still have this ridiculous situation where the very cheap money in the term funding facility at 0.1% has been lent to the banks, and they don't need to pay it back for a year or two. And by the way, they're actually earning money on it because it's lodged back at the RBA, and the RBA is paying our money to the banks to help with their profits. And of course, the lending standards are way too loose here in Australia, just as they were in New Zealand. And again, the bank was too late to the party with its interest rate rising. And it is possible, of course, they will go too far now, but it's about being too late to the party in the first place. So, to my mind, this article is really important. It gets to the heart of it. Why was it that reserve banks around the world, both in Australia and New Zealand and elsewhere, all did the same? All made decisions way too late, and all were too slow to react. The truth is, they had groupthink. The reason they had groupthink is because they are fundamentally connected to each other via the Bank for International Settlements. They all talk to each other. They were all seeing the problem the same way, and none of them really understood what they were doing. Therefore, there needs to be a very strong level of accountability at those central banks, both locally and globally. And I do put some point back there to the Bank for International Settlements, which is the banker's banker. That, of course, is where many of them also have other jobs, including Philip Lowe, of course, and they all are connected with each other. But there's also plenty of blame to go around with the politicians as well, who took the easy way out and are still pointing the finger at everybody else but themselves. But the truth is, to my mind, the real lessons are yet to be learnt. And that's a problem, given where we currently are. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.